Good morning, traders. Today is Monday, the 18th of October. My name is Neville Hornsey, market analyst for YouTrading, and today I'm joined by
Joel Frank, also market analyst for YouTrading.
Yeah, how are you doing, Joel?
I'm all right, mate. I'm all right. I had a pretty chilled weekend. What about you?
Yep, same. Yeah, not a lot happening,
Nice.
which is good. So nice and restful.
Yeah.
Last week was, how would you describe last week? I'm going to say bullish last week was the markets. How would you describe last week?
Yeah, I mean, for risk appetite, definitely bullish. Like I'm just looking at all my charts here. Stocks higher globally. I think I pointed this out in one of my briefs. I can't remember if we spoke about this, but there was quite a key technical break that I saw for definitely the S&P 500 and the stock 600. Mm-hmm. They'd been trending lower. And there was this key trend line that had been sort of suppressing the price action. And I think it was on, what day was it? On Thursday. That was the day, the biggest.
The big one, yeah.
The big one. That's when it looks like we broke to the upside of that sort of downwards trend line. And technically speaking, that's kind of a good sign, isn't it? We're also above the EMA now as well.
Yeah. So, I haven't got any EMAs on the chart, just on the closes.
That's it.
The highest close was up here, and that's from 6th of September. Then we had another spike higher, 24th of September. Then we had the 7th of October. And then, we broke out of that quite solidly on Thursday, like you say. Big one. Yeah,
I think as long as earnings, because I think a lot of that was an earnings-driven move. Like we had the bank earnings coming out good, which is always a good sign for the economy. Got a lot more earnings this week. If they're decent, then I mean, it's feasible that we could test the record high from early September.
Yeah, I guess we should do like a Fibonacci because it looks like it's gone way over.
Yeah.
So it's like in the sort of deep retracement. So if they are going to turn it, it'll be around now, I reckon. Then in terms of like support and resistance, we obviously had big resistance back in July, which became support. They broke through that, became resistance again. And then Thursday broke through it again. So the next one is up here where we've got this sort of balance area, resistance, and that's kind of where we are. So if we get to like 4,500, then they might as well just try and tag a new all-time high. But if they're going to turn it, they might turn it today or this week. But
I mean, things like we were saying this before, but like Asian markets didn't start the week very well, did they? You had weaker than expected Chinese GDP data, industrial production data for September, pretty soft. That's not great. Also, you got commodity prices surging still. Like I'm just looking at copper, which is up more than 1%. WTI's at multi-year highs, and that's pushing yields higher. Mm-hmm. And obviously, when yields go higher, that sort of reduces the appeal of holding stocks for their dividends. Yeah, because it increases the opportunity cost.
And I'll add in March of this year. So when was that? That was all the way back down here. This sort of little corrective period, there was like 900 odd billion dollars worth of fiscal flows going into the markets. And then obviously some of that trickles down into the sort of corporates. And now we're like around the 500. So almost 45% drop in the money sort of flowing in from the sort of government to the non-government. So, this rally here might have just been essentially like when the bulls are going higher, they sell off, don't they? So they sell out their position. Then you get like a corrective period. And then this could be like when the bears actually step in, because we're waiting on earnings, but if basically the earnings for like projections forwards are, really down, then that's when the bears might sort of take the sort of initiative and start selling this off. But
that was the fear, and early last week that was definitely the fear, like that recent energy price surges, supply chain disruptions. I mean, that still is a fear that a lot of these companies are going to be reporting basically negative things to do with all of that, which could then send these stocks lower again. Those fears have been eased a little bit by the situation with the banks, like some of them reporting like record earnings and all that kind of stuff. So we're going to have to wait and see, really. We've also got to keep an eye on bond yields, because like I've said, they're moving higher as well. And if it's short end US bond yields, like the US 2-year has been shooting higher in recent days, and that reflects bets that the Fed is going to start hiking sooner than people have been expecting. So I think I read this morning that a rate hike for next September, so that's under a year away, is now nearly fully priced. Yeah. So
looking back at the euro dollar, like we sort of talked about last week, that continued to fall. So that means yields and interest rates are projected to go higher. So,
exactly.
And that was, they were trading mainly in September and December next year. So that's, I think, that is how the market sort of works on that timing issue. Like when you sort of see the euro dollar futures monthly volumes rising on the CME website, then you can sort of say, well, September is obviously when they're sort of gearing towards those dates, or then it was December. So September and December were the two 2022 contracts that were trading with most volume. So that holds true. TLT, the long bond, that did have a bit of a bullish push last week. I guess on there was like good demand for the actual sales, like the auctions. So that was good for the long bond ETF. And the dollar index obviously sort of went nowhere really last week. So the actual dollar itself is going sideways, which, you know, can be a push up sideways and then another push up, or it could be a drive, consolidate and then drop. So it just needs some sort of directional move now out of this little consolidate. Well, not even little, it's like 2 weeks. This is the third week of consolidation, really.
It's just stuck to 94, isn't it?
Yeah.
Yeah. The thing with the dollar is at the moment it's facing like, what's the word? It's facing crosswinds. Like it's got bullish winds and bearish winds. So the bullish winds come from the recent moves that we've been seeing in US bond yields, which are mostly being driven by expectations for a more aggressive rate hiking cycle from the Fed. That's a dollar positive generally, because those same moves aren't being like in the euro, in the yen, as in for the ECB, the BOJ, they're not expected to do anything. And those are obviously the biggest constituents of the Dixie. But then on the other side, the dollar is a safe haven currency. So when you see the gains in stocks that we saw last week and in other risk assets and in commodities as well, that's a negative for the dollar. So as long as those two factors are working against each other, we might see the dollar continue to remain kind of stuck. But if one of them gives way, for example, if risk appetite starts to give way again, like we have seen in recent weeks, but yields continue to move higher and hawkish Fed expectations are still there, that's when we could potentially see the dollar shift higher. Well, that's a scenario.
Yeah. Okay. We'll definitely watch out for that. So like last night we had the Chinese GDP quarter years. That was bearish, just under forecast as well. And we also had higher CPI out of New Zealand. So inflation's definitely, like, it's not as if China's exporting deflation. You know, the prices are still going higher for everything. How should the market react to China and New Zealand?
Yeah, I mean, the data we had overnight from China and New Zealand kind of highlighted a worry that's been on the mind of markets for quite a long while now, which is perhaps why we've seen a bit of risk off, but not too much risk off, because this has been something we've been thinking about for a while. The theme of growth slowing, which the Chinese data showed, but also inflation picking up, which is what the New Zealand data showed. Yeah. And at the moment, I mean, you're seeing stocks moving higher, which indicates, I think, that there's a confidence that, okay, growth might be slowing, but growth is still going to be at decent levels. And inflation might be rising, but we still believe in the credibility of central banks to bring it under control and keep things stable. So, yeah, I think that sort of confidence is still there. But, you know, if these commodities continue to surge, then that confidence is under threat.
Yeah, Brent here has definitely gone past the sort of 50% mark of this measured move towards the $90. So is that going to be bearish for the, like the New Zealand dollar and things like that? Because New Zealand dollar has come off since that inflation data.
It's an interesting one. Just with regards to this morning's price action, that downside in the New Zealand dollar is probably just sort of in tandem with like global risk appetite, which is a little bit risk off this morning.
Yeah.
Money markets in New Zealand already expect a lot of hikes from the RBNZ. So they might be pricing in a few more now, but is there really that much more that they're going to do now? Because we're already expecting another hike this year and multiple hikes next year and the year after. So maybe it's just a good time to take a bit of profits. The PBOC wants to keep the yuan at relatively strong levels so as to insulate the Chinese economy from the effects of global energy price inflation.
Okay.
Because if they allow their currency to weaken to reflect weaker growth and all this stuff we've been talking about in China, like this morning's data highlighted, then energy is going to be even more expensive, and it's already like super expensive. So I think it's a bit of a tactic from them.
Hong Kong's Hang Seng rising today, like you say, with all the other equities markets. FTSE tested the sort of range high. It's sort of come off a little bit today, and Dow Jones obviously broke out above some old resistance. Now I was going to see if it's acted as support before new all-time highs. So tomorrow is Australian monetary policy meeting minutes. That surely they're not going to do anything different.
They're one of the more dovish. Well, they're one of the most dovish G10 central banks. In fact, I think what you just want to look out for there is a lot of other G10 central banks growing increasingly concerned about inflation. That's not been the case yet in Australia. So we're just waiting for that shift. If it's going to come. So maybe there'll be some hints of some people worried about inflation in the minutes, but I don't think it's going to be a big deal for the Aussie, to be honest.
Okay, so we'll keep looking at the US dollar for Australian US dollar. Then Wednesday, we've got pound CPI, or UK CPI year over year, and CAD CPI month over month. That's obviously the Bank of England have, almost desperate now to start raising rates, aren't they? So Bailey's pretty much said as much over the weekend, hasn't he? Odds on that. We're almost definitely going to get rate hikes by the end of the year now. Money markets are almost certain about it. So it's definitely going to be worth watching that data. I wonder if the pound's going to stick at this level then, because we found the 200 daily EMA. We found old support, now resistance, broke above it, but couldn't sort of close above it. It just looks like this wants to go higher. And I guess if we do get a rate hike earlier than than anticipated, then you would have thought the pound would have been able to break up again today, but not happening.
I've got a feeling it might happen. I need to do a bit of research into this, and maybe I'll write about it later in the week. But I got a feeling that UK bond yields have rocketed higher, and like way more than US yields, way more than yields elsewhere. Particularly like the 2-year UK yields, but the move higher in sterling hasn't been as sort of like large, basically, which might imply that sterling is a little bit undervalued at the moment, considering the yields you're getting on UK government bonds. So potentially there could be a bit of a catch up, which would be, could be a bullish thing for sterling. I need to look into that though to see how much undervalued sterling is right now.
Technically, it had resistance back in 2019 and 2020. It broke above when, that move up in 2021. It came back down to that old resistance, found support. And that's also on the monthly moving averages. So this could, if traders were just technically trading this, I'd imagine they would have bought back down at 1.34 and they'll be targeting the highs at 1.43. So it's just whether or not the fundamentals can back it up now. So because that'd be a good. If we do get back up to those highs, then we're looking at a double top. And I always love a double top on any time frame. So there's definitely going to be but then it could accelerate up to this 200 period moving average on the monthly chart. So back up to this old support here. So yeah, all good.
Holidays would be very cheap if we could get out there. That'd be great.
That'd be I'd love it. I don't know if you remember, but when a pound was 2 to 1 for the dollar and stuff like that, it'd be so good.
Oh yeah, I can't remember that. I think I was probably a kid.
No, but I remember here. Tell you what, it's 2007. It wasn't that long ago. It's just
true. Pre-crisis.
Exactly.
True.
But that's when you could almost get trainers for half price. Amazing.
Look at that move lower during the crisis.
Yeah.
That's just insane, isn't it?
It is. And yeah, I don't know if we'll ever get back up to 2 to 1, but we're definitely back into this range, the 1.5s. Yeah. We'll see.
That's if you want to think about those very, very long-term levels, you need to look at what's it called? Purchasing power parity, which is where they basically compare the cost of goods in different countries and then look at the exchange rate and see how much off the PPP is.
Yeah, last week was a down week for dollar and up week for CAD, and then today's just a bit of a bounce. And we've got 1.244 as probable support turning into resistance. Anything we should keep an eye on Canadian dollar? Or is it just watch the oil markets really?
Definitely watch oil markets. I think with regards to the Bank of Canada, we've got some important, we've got something called the Business Outlook Survey, which I believe is out today. And also a couple of BOC members speaking this week. We haven't really seen as much focus on market expectations for hikes from the BOC. I mean, we're basically thinking that they're going to hike around a similar time to the Fed. So just anything that might tweak those expectations, bring them forward, perhaps signs that inflation is picking up more than expected in Canada, or that BOC officials are more concerned about inflation now than they have been in the past. Anything like that will be worth watching out for CAD.
All right, cool. All right, so for our 340 viewers or subscribers, how should we describe the next week? Do you think it's going to be a good week or a slow week?
I think it's probably going to be a bit slow. But you just got to keep an eye on the big earnings, like tech names and stuff. We haven't really got any US data to really sink our teeth into that's important. So it could be a bit slow. There'll be a lot of, if you're an FX trader, there'll be UK events, Canadian events, EM central bank events. So you can have some interesting stuff to trade off of there. But as far as global macro is concerned, it's earnings and then it's PMIs on Friday.
All right, cool. All right, let's see how it all pans out then.
Yeah.
And have a great week, and I'll speak to you next week.
You too, mate. Speak soon.
Take care. Bye.
Bye.